Hey, it's Richard with Matthews Wealth Management. We're going to be doing the August market update video here. Just kind of cover all the asset classes that we follow under modern portfolio theory. And we got some key topics and inflation to cover. So let's jump into it. The first thing that we noticed for the month of August is it's a continuation of the growth fad. So you can see large cap value and core 1-1, and then we have a 4 right there, 4%. 2-2, 3.5, not so much. 2, 1.5, you kind of see it again there. When we go to the 3-month, it's actually even more obvious. You go from 0 to 17, -2 to 13, -3 to 6. So you can kind of see that that trend is continuing, and that's going back to the month of June. June, July, August is really what we're seeing there. Internationals just kind of staying flat. We had a rebound in emerging markets. That's going to be currency driven. Tips and long terms, that was the big bet that we made back in February across the board in our client allocations. And when we say we make changes, it's just a few percentage points shading towards certain asset classes or away from others. But when we made that move, it was in tips and long-term bonds. And if we had a February until we would see the actual gains here, but big returns that we've seen have started to tip. So I think we might actually be at a point there, especially with the fear of quantitative easing pulling back by the Fed, which basically means 60% of the bond issuance is bought up by the Federal Reserve. That's going to start lowering. And will there be enough people there to continue keeping those prices high? I don't think so. So that's kind of what we're looking at there as being a big change. High yield, nice and boring. However, if the Fed is no longer buying a high yield, we're starting to see the high risk in high yield. And that's kind of our take on it for a reallocation or rebalance. Real estate still going strong. If you've watched these, you know my thoughts. Oil took a big downturn. There was a big discussion with OPEC about supply, and at the same time there was a change in demand. We're at Labor Day weekend was last weekend. I'm doing this, I think it's on the 8th of September now, so I've got, again, another week's heads up from what's happened since this 1 month. But anyway, S&P for the month of August up 3, moderate, trailing by more than half, so that's a interesting take on it. We don't see anything really different except you have the flip-flop of oil and gold between the 3-month, and really big difference here. If you just look at equities, you got double digits everywhere. Our biggest return year to date has been down here at oil. Real estate would be second place, surprisingly for me. Then we have the 27, 24. There's just big numbers of return for the year. Bonds, as we've seen, have been single digits and some negatives. If you look at the long terms before February, there was a big sell-off there, and gold is down on the year. So S&P is up 21.5. Moderate portfolio is it's greater than a third, so that's a good thing. You can actually do some ratio looks here and see that we're starting to see things flattening as far as the ratio from moderate to an S&P. So let's take a look at the key topics. There's a lot going on right now. I'm including some topics that are current in the month of September already. So the debt ceiling. There's big talk right now in budget reconciliation and a bill and stimulus and infrastructure spending. There's a problem with the debt ceiling again. So to avoid a government shutdown in October, something's got to be done. And there's going to be some politics being played about how that's going to work out, who's going to be pressured, who's going to walk away with a win. But the debt ceiling is creating a major issue. The most important part is that the Treasury maintains a cash balance usually to fund the government and prevent these types of situations. And during COVID, they've expended all of their reserves. And so that means that new debt is not offset by assets that are spent into the economy. New debt equals new debt, hence the debt ceiling. So that'll be an interesting thing to see people navigate. Unemployment, we're going to keep our eyes on it. Unemployment's gotten to be a little bit of a weird indicator lately, but benefits have ended as of now, as of me saying this. And there's a report that came out that 2.2 million more jobs than unemployed people. I think it was like 8.9 million job openings right now, but 2.2 million of those more than people looking or able to work. So if the Fed wants maximum employment, maybe we'll see benefits ending start to fill some of these jobs that are open. GDP projections, y'all know my thinking about tracking metrics and how that's gone over the last year or so, but GDP projections from Morgan Stanley and Goldman Sachs were severely slashed. We're talking from 9% GDP growth for the year down to 2.8. So a lot of that has to do with supply chain dynamics, a lack of demand with no more stimulus spending, and things don't continue the way that they have. We're not producing anything, but we're consuming a lot. So those projections were slashed, and to the point where Nowcast, which is a GDP forecasting tool that the Federal Reserve uses for their financial policy making, they've now suspended it. They're no longer going to use that because of the volatility and the underlying variables of GDP projections. So just like we saw earlier with M2SL, I think it was back in January that they retroactively suspended and changed the metric. We're doing that now with GDP, which is a very foundational number that we should know. Lastly, this is part of the legislation that they're looking to pass. It's relating to financial privacy. So the IRS is now requiring the reporting of transactions, so buying a tank of gas or going to the grocery store or picking up your medicines from Walmart or whatever it might be. Any transaction that occurs in an account with more than $600 in it has to be reported to the IRS. Seems like a Fourth Amendment issue, but we'll see how that works itself out. That's supposed to be in one of these new bills that they're passing. So yeah, that's a lot of oversight over the day-to-day. So just be aware. I think there's some reporting links if you want to write your congresspeople and tell them how you feel about having all that information be reported to the IRS on your behalf. So if we look at the overall inflation, we're sitting at $20,534,600,000,000. We had a little bit of an uptick, and actually if you annualize it, it's a very big uptick, but just under 0.75% for the last month is money creation, basically is what we're tracking here. Since January, we're up about 5.9%. If we go back 1 year, 12%. So like I say, this is how I look at inflation, is just money that is now circulating if there's more money chasing the same amount of products, prices go up. So therefore, 12.11% inflation in the last year. And pre-COVID, January 2020, we were up 33%. And if you go and check the price of used cars, fuel, maintenance, rent, anything else, I bet we all believe that, right? So anyway, hope that was short enough for you. I tried to make this really quick, but wanted to spend a lot of time on these issues. If you have questions, feel free to call us. We're here to talk. We're about to dive into reallocation. Things are getting pretty busy behind the scenes at Matthews Wealth Management, but we finished up our meetings last week, so good to go. Again, if you have questions, follow up, and we'll talk to you next time.